Emerging markets as an investment opportunity have been stealing the headlines this year as an attractive opportunity, but it does not come without risk. Well, to look at fund flows and the emerging market space in more detail, we're now joined by Wei Li from iShares at BlackRock. Wei, welcome. We've spoken about the opportunities within emerging markets before on this platform, but what is it that's brought emerging markets to the fore?
I think so far this year, a lot of the outperformance of emerging markets over developed market equivalent, as well as a lot of the inflows that has gone into emerging market versus outflows from developed market, has to do with tactical reasons, because it is an asset class that is owned so lightly by a lot of the international investors, and it is an asset class that is really quite cheap in terms of valuation, that when things are not looking that badly anymore compared with earlier this year, investors wanted to catch up with the trade, which is what we have seen.
When we've spoken about emerging markets in years gone by, we're talking about small economies with small impact on the global space. Now, in amongst some of the top 10, top 12 economies in the world, you've got China, you've got Brazil, you've got India, and these are large economies now that have global influence, aren't they? So they're not really emerging anymore, are they?
Well, this depends on how you define an emerging market. From the perspective of the size of the economy and from the perspective of the incremental growth, because emerging markets on aggregate deliver half of global GDP incremental growth these days, it definitely doesn't seem small on aggregate as a block. But in terms of the degree of development, in terms of the efficiency of the transmission mechanism of top line growth into bottom line profits, emerging markets, including China, including India, and definitely including Brazil, are still far behind in terms of the transmission mechanism in developed markets.
Before we take a look at fund flows, just want to take a look as well at what influences emerging markets. And I mean, we hear a lot about the influence of the US economy around the world, and of course we have to consider the dollar, presumably. There is the oil price concern. What are the factors that most influence emerging markets?
This is a topic that has become increasingly important to focus on, because what I said earlier on around so far this leg up in emerging markets being tactical in nature, and now we're going into what in May, and a lot of investors that have benefited from the leg up in emerging markets are now asking, is it time to sell in May and go away? So they're increasingly asking themselves the harder questions, the fundamental questions around drivers of emerging market. And the way that we look at it is roughly threefold. What's going on in China, and this tackles the more difficult reform issue as well, more than just the short-term stimulus cycle. What's going on in the commodity space, and this goes beyond oil, but oil clearly is a big driver, and the broad global liquidity environment. So we're talking about not only the Fed policy and its impact on the dollar, but also where emerging market central banks stand. Can they cut rate to offset potential tightening from the Fed? And all of this needs to be considered to have that broader and longer-term conviction for emerging market that goes beyond the tactical nature.
What is the problem? Is it because emerging markets borrow in dollars?
That, to a large extent, yes, indeed. A lot of the recent ramp up in terms of debt and leverage in emerging market have taken place in the corporate sector, in the private space, as well as in external currencies, which make them a bit more vulnerable when currency moves go beyond their expectation.
Okay, let's take a look at the fund flows now, because I think from an investment and a trading opportunity, this is a good angle here, because we've established that emerging markets are going to be top of the list for anybody looking at global exposure. What about the fund flows? What is happening?
As at mid-April, emerging market equities actually is the single most biggest asset gathering category within global ETP space from the equity perspective, which is somewhat surprising given the fact that at the beginning of the year, nobody would have thought the emerging market would pull out of the hat this incredible rally and incredible asset gathering pattern. But that definitely has been the case, and the momentum continues continue to persist, which is also somewhat surprising, especially given that in developed market we have seen investors de-risking. So more recently, US high yield has gained a lot of headline in terms of outflows, specifically last week, and US equities have seen a lot of outflows as well. But emerging market, against the broader backdrop of investor de-risking so far, have actually seen inflows. So that's in the equity space. In the EMD space, the inflow has even been more persistent and more steady, in the sense that we have seen a lot of inflows earlier this year going into dollar EMD, and then local EMD started to catch up with dollar softness earlier this year, helping EM currency to recover. And now we're seeing a more balanced mix of inflows going into both categories of EM debt space, and that is really interesting to note, because now currency started to stabilize. We don't see EM currency starts to go up as fast as before, but I think investors are still looking for carry, looking for yield.
So what should we be looking out for that might turn this around, or might give us a different direction for whatever reason? What are the catalysts that you'd be watching out for to change the appetite?
What could spoil the party? There is the big concern that given how dovish the Fed has been versus beginning of the year, i.e. they met markets somewhere in the middle, adjusting the dot plot from 4 rate hikes for this year to 2 rate hikes this year, and currently market pricing is 0 rate hike for 2016. So there has been a lot of dovish repricing in terms of policy from the US. Just how much more dovish surprise there can be to further boost the emerging market is raising more and more questions. So this is one thing. And the second thing to watch out for will be around, so far oil price has really rallied a lot within a very short period of time, and some of them has been speculative in nature. So until we see meaningful cap or meaningful discussion around production on a global basis, where we move away from everybody out to get market share to everybody approaching it in a more coordinated fashion, we could see further disruption, and that could bring volatility to oil market, and that could bring volatility to the emerging market more broadly. And now China, lastly on China, China has been a bit of a tailwind more recently, with data stabilizing, helping improvement in broader sentiment towards emerging market. But going into later part of this year, investors will question around the quality of growth in addition to the headline growth number. And when we break those growth numbers down, it may well be a case where investors think that the country hasn't delivered enough reform, and they start to question again.
Okay, all right, interesting subject. But thanks indeed there for joining us, Wei Li from iShares at BlackRock, there with a look at the emerging markets and some of the influencing factors to watch out for.